Back again. This is millionairemob.com. Wanted to provide a guide for everyone here on something that's near and dear a little bit to my heart here. Something I think is not talked about enough in terms of the dividend investing world. Hopefully, others catch on and understand the importance of this financial ratio. But this is a ratio that I find very important if you are a dividend investor or a dividend growth investor. And that ratio is really uh, price to earnings ratio less dividends per share. So it takes the component of dividends per share out of the equation of PE ratio. So basically, whatever's left of the company after it pays dividends, what's really the value of a company um, post dividend and what they're actually reinvesting into the company to and relative to equity holders. Um, so one tool I like using is Finbox.io. As you know, I've mentioned this before. It's just a tool that I'm obsessed with. You can use basically any screener that's out there. You can use a lot of free tools. Um, Finbox, at least for me, is kind of like a all-encompassing sort of. It reminds me of back when I used to work in investment banking. You know, has all the tools and Excel plugins for me to do successful fundamental analysis on stocks. So I'll show you exactly how I think about, you know, this price to earnings less dividends ratio or um, PE less dividends ratio. So here with Finbox, you can go right into a watch list. Here we have Dividend Champions, which is have increased their dividends for at least, uh, I think that might be need to be corrected, but I think it's at least 10 years, and I know Dividend Aristocrats are 25 years. But anyways, I mean, this is a list of 113 stocks of, high quality dividend payers that have increased their dividends over time. I like investing for dividends and income, but not just I'm not chasing yield out there. I don't really care about the dividend yield, honestly. Um, I have a little bit longer runaway in terms of dividend income and increases on dividends over time, and so honestly, I'd prefer to invest in a stock that pays extremely low dividends per share uh, relative to earnings per share, and so low dividend payout ratio. Why? Because, well, I have certainty in terms of what they're going to be paying out in the future. I know that that's probably not going to get cut. If anything, it's going to increase over time, and thus why I truly, truly love the price to EPS less dividends per share ratio. It's something I basically made up. I haven't read any really articles about it. I don't think it's been spoken about much, and so here it goes. I'll show you exactly how we should look at companies. So now that we have the dividend champions here, this whole list of 113 stocks, great powerful tool about Finbox is you can start for $1 and try it for premium, $1 for 1 month. Nothing better than that. You can uh, join via my link. I'll put it in the description below. Um, Obviously, feel free to use any other tool out there, but for me, this tool is exceptional and beyond anything else that I've ever experienced, besides working in corporate finance and investment banking, where we'd pay in excess of $20,000 or $30,000 per user. Here now, I pay $39 per month to use Finbox. So what you can do is actually export this list of 113 different stocks into Excel. And Finbox actually has a Excel plugin, as you can imagine with I had mentioned in my prior videos. They have an Excel plugin that enables you to pull in whatever ratio, whatever metric you want to pull in directly into your Excel sheet based off of a ticker. So for this analysis, here's this list of, I mean, look at all the different Finbox metrics here that you can pull into your Excel spreadsheet. For us, all we care about is right now earnings per share. Um, don't really care about forecasted EPS. I'd rather just look at EPS on a LTM basis to match up with dividend yield. Um, Sorry, bear with me here. I know it's so here's basic EPS. We'll want to do that at least on an LTM basis. Let's go back to our sheet of Dividend Champions, FNBX, ticker, comma, EPS basic, LTM. Let's put that in. Put that in quotes. That should populate. EPS basic. Okay. Let's bring that down for the entire list. Uh-oh. Looks like we had a crash on Excel. In the meantime, while that's reloading, that has not happened yet for me. So sorry about that. This is normally, it's the first time this has happened. Nevertheless, the data's still here. You can just FNBX. It's a good chance for you to sort of see how everything is functioning. Basic EPS. EPS. Let's put the dividend per share is just dividend. Let's just copy this back in. So there we go. Remember, basic EPS dividend per share. Okay, so now we have everything we need. Earnings per share less dividends per share. Okay, so this tells us exactly what we need to know about each stock. What earnings are they reinvesting into the business after they pay dividends? One thing that where this originally sort of came out of is I've gotten a lot of scrutiny from other investors out in the marketplace that say, well, you know, dividends are paid out of equity anyways, and so thus you're already decreasing your earning it's coming out of your total return anyways, right? But actually, there's a balance to both, in my opinion. So as dividends are paid out for each company, yes, they could potentially be putting that into growth, but you'd actually be surprised. More often than not, there's a lot of companies that end up reaching for acquisitions that just don't make sense. I like companies that actually reward their shareholders. Um, for example, Twitter at one point in time acquired Vine just to shut it down. That's not a use of capital that I would approve of, right? If I was a board, if I was on the board of the company. Um, but paying a dividend, a small, meaningful, just small dividend that at least shows good faith to the shareholders, I think that's reasonable. Companies get very large, and over time they're doing what they can well, and to manage their capital by paying a dividend uh, is actually a prudent way, in my opinion, to show good faith. But at the same time, they're growing their company just as they would otherwise. Sometimes they'll pay a dividend. Companies will not pay a dividend, use that extra cash, and do some sort of exploratory experiment that ends up being a total waste and use of capital. Um, any company that does pay a dividend, there's no shock out here that a lot of these are companies that you recognize. Aflac, Archer Daniels, ADP, Colgate. I mean, some of these are consumer products, yes, but Chevron, but at the same time, they're products that or they're companies that um, have a prudent use of their capital. They're conservative in terms of their capital structure, et cetera. So I won't go on a tangent more than beyond that, but um, that's basically where this valuation metric arose from. And so really now that we know everything that we have calculated here, now it's up to us to come up with a valuation of these companies. So price to E. Honestly, I don't think this has ever really been explored out there before, but let's call it. If it has, I've been reading the wrong financial articles, but to me, this is out there, uh, at least from my perspective. So let's call it PED ratio, price E minus D ratio. So E is earnings per share less D, which is dividends per share. So now we have all of our dividend champions calculating off of this. There's some companies that have a negative PED ratio, which means they pay out more dividends than their most recent EPS. Now, there could be some one-time items in there where adjusted EPS is probably higher. Um, for now, for simplicity purposes, we're not forensic accountants. I can get into that later, looking into adjustments and validating those. But for now, let's just take it at face value and understand companies that are dividend champions with attractive valuations from a PED ratio perspective. So let's just filter this. Okay, it better be greater than 0. Let's just do less than 50. And then let's do smallest to largest. Okay. So now we have TDS, NACO, Aflac. I love Aflac right now, still at this valuation, rising interest rate environment. I think they'll still, the earnings, their balance sheet will decrease in value as the bonds that they hold on their balance sheet will decrease of par value as interest rates go up, but the money that they reinvest will result in a higher earnings yield. And so, yeah, I love Aflac. I wrote an article about it. Still a very attractive price to earnings per share ratio, and then especially a price PED ratio of basically 9 times. As you can see, they earn 6.4 earnings per share, and they only pay out $1 in dividends. Significant runway for further dividend growth. it only pays a 2.2% yield, but if you invest in it now, um, I can assure you 5 years from now that they will most definitely be paying more than $1.08 per share. That type of assurance, no pun intended, is something that I love to see, and every other dividend investor should as well. So as you have here, you have it. I will sort of leave you at this. Um, if you found this video interesting, I'm happy to send you this exact list and analysis that I conducted here. But now we have, call it 13 stocks at a sub price PED ratio, price to earnings per share less dividends per share ratio. I'm invested in a number of these stocks, including Aflac and AT&T, Archer Daniels, Pentair, Walgreens are another positions that I would definitely explore further. I own Target as well. Um, so yeah, here you have it. I think this is a great way to look at dividend stocks in terms of one, just your safety off of your dividend and ensure that those dividend checks are going to be coming in for the foreseeable future. I can tell you that without doing much diligence, I would say out of these 10 companies, 9 or at least 8 of them will pay a dividend or increase their dividend over time for the next 5 to 10 years. They're both attractively valued. Yes, they may be slower growers, but they have opportunities to extract new areas of growth because they do pay very, very low dividends per share relative to what they're actually earning. So there's still room for them to take some of that cash flow and reinvest it back into the business. So that's it. Uh, Check out millionairemob.com. Check out my free guide to investing. Highly suggest that you evaluate or do at least the free trial on Finbox Premium. It's just costs $1. If not, there's plenty of other free resources out there. I'm not completely wed to Finbox, but I do think it is a tool that every investor should use. Feel free to let me know if you have any other questions in the comments below. Would love to hear from you. Love to keep the conversation going. Uh, Thanks for watching.